Mortgages 101 and Lending 101 today. So I'll go ahead and hand it over to y'all if you guys want to do a brief intro and then just get into it.
Thanks, Amber. So as you mentioned, I'm Travis. This is Tyler. We are your partner, your preferred lender, whatever you want to call it, at Streamline Home Loans. So just a little bit about Streamline. We have been over here for about 13 or 14 months now. Things have been going really great. As far as us, we've been in the industry for many years. I started at a local bank / credit union doing kind of management stuff, with the last 9 years being mortgage lending. And within that time frame, kind of met Tyler at one of our old operations. On a personal note, I live here in South Austin, have a beautiful 15-month-old daughter, as I mentioned, with a daycare crud. I love the live music scene here in the Austin area. I'm also a coach for the Special Olympics. So you can find me doing one of those two things when I'm not changing dirty diapers.
I'm Tyler, and like I said, Travis and I have been working together for almost 9 years now, just at different places, and we're always individual loan officers, but we always work together as a team. But now we're officially on a team together, which is pretty exciting. Don't stress if you can't remember who's Tyler versus Travis, because we answered to both because we've heard the name so many times. But like I said, on a personal note, my wife and I, kiddos, we live out in Drippy Springs. I used to only have 2, but now I got 3. So we got 3 boys at the house, 7, 4, and a 4-month-old. So I got a joke with somebody walking in. She said I was pretty chipper this morning. I said, well, I'm warming up by about 4:30. So I've already had a full day. So, but yeah, we'll get into it, run through the basics, and go from there.
Yeah, absolutely. And the point of this class is not to make you junior loan officers by the end of this. If you want to become one, come talk to us, but really just to try to give you enough knowledge and understanding of what we kind of do behind the scenes, and also maybe give you some something to take away that you feel more comfortable talking to your clients about. There is a fine line of talking to them about lending, but it is nice to know some of the terminology and things that we're going to be talking to them about. So just a quick overview of what we're going to cover. We'd like to talk about your role as an agent, some of the upfront questions, boundaries, education, understanding the math, which really has to do with some of the behind the scenes stuff that we do, but definitely want you to kind of get an idea of what we're doing for your clients. And then an introduction on loans, multiple types of loans, hundreds of options out there. And once we get to know your clients, profile a little bit better, and more importantly, their goals, we can kind of narrow down what's going to work the best for them. And before we even go to the next slide, I should have mentioned earlier, this class is definitely interactive. So if y'all have any questions while we're in the middle of this, feel free to stop us, ask questions, whether it's generic or a specific example from one of your clients. Like, we always feel like it's really informative and helpful when y'all have stuff for us, because someone else might have been thinking about it. So feel free to ask questions along the way. So briefly, like, your role as an agent is definitely, to ask questions and build that rapport and gain trust. You probably have noticed, or you will notice, when someone gets excited about buying a home, the first call they make is to the realtor. Now, I kind of think you should be calling the loan officer first to make sure you can get approved for a loan, but people get excited about the house. So they're going to call you first, and you're that first point of contact to build that trust. And definitely assess their needs of what they're looking for, what their time frame might be, all of the things that go into finding their home. And because you are the kind of the point person in this transaction, you kind of have some control. So setting timelines, and what I mean by that is, I got a call on a Saturday after the UT Alabama game. Someone called me looking for help, which is cool. We take calls on the weekends when we can. They said, yeah, I really need a house by Thursday. I'm like, well, okay, let's talk about that. But also what you should expect in the process, know that it is we like to call it a journey. Sometimes it, takes a little while, and maybe they go through multiple offers or things. So just kind of expectations of what is coming along. You can kind of control all aspects. Sometimes we'll provide information as the lender, and they might call you right away and say, hey, my lender told me X, Y, and Z. So again, you're a coach in this. And ideally, you could refer a lender to them, and we would love to earn your business. But no matter who you're working with as a lender, like, you should have a relationship with them. Like, it's a partnership. You 50% you, 50% us. Y'all get to go show them the beautiful homes and whatnot. We get to put them in debt for 30 years. So And then, setting or identifying any potential pitfalls and setting rules going forward. What I mean by that is, if you hear that, oh, hey, I'm about to quit my job and start my own business. Whoa, maybe you need to talk to Tyler or Travis about that first. And then setting rules going forward as far as being responsive and things of that nature. Common questions asked, like I mentioned, have you spoken to a lender yet? Need a referral? It's such an important financial tool. It's always good to shop. Most lenders, including ourselves, our rates are, fairly competitive with each other. You can't be too high, or, you're not going to be able to get any business, but it is worth it, shopping around. So, and other lenders lenders have different products as well. So maybe one lender doesn't have something, but maybe we've got it. So always good to shop around a little bit. Do you have the earnest option and inspection cost? So we're going to talk about some products to help with overall costs, but we see this occasionally that someone has literally $0 to do that. And earnest money is typically 1% of the purchase price. So it's nice to know that that person at least has that commitment for the transaction. What price range and what monthly payment they're looking at. These are things to know, because if someone tells you they're looking for a $1,500 payment, but they want a $600,000 house, those two things don't really go together. So just kind of getting an idea of what they're looking for. And on this note, like both Tyler and I, when we get an application, one of the first things I like to ask is, what payment are you looking for? I don't start with, hey, well, your maximum mortgage approval is this, because they may not want that payment that comes along with it. So getting an understanding of what they want to spend on a monthly basis really helps us with programs, purchase prices, maybe even what area we're looking to buy in. And then a time frame of wanting your purchase. As I mentioned, I brought up the call me on Saturday, home by Thursday thing, but just getting an idea hey, are they in a lease and are they need to be out in a month, or are they thinking next year? All of those things are important when we're working on a pre-approval. Cool. You want this one?
Sure. Rules establish that mortgages are great, but they require work. And obviously, y'all helping advocate for getting documents, all those things. It's teamwork. So and just like it says, keep the grand prize in mind. Some people, like I said, it's a journey, it's a process. We're always working together. To be honest with you, we hope it's not overly stressful, because it is a big deal. But as long as we're all communicating, hopefully it should be a good process for them. Must be responsive to lenders' requests. Normally we try to keep y'all out of the extra emails and the extra texts and follow up. But some people, we try to create as much urgency as we can. But hey, yeah, I'm busy at work. I'll see if I can get it tomorrow night. Yes, ma'am.
I was just going to ask, are we going to get a copy of this?
Yeah, we can send it to you.
Oh, for sure.
Yeah, definitely.
Awesome.
It's $10.
Yeah. Yeah. So we'll try to keep you out of the picture as far as helping follow up on things. But sometimes borrowers aren't getting it. Hey, we all know there's a deadline on the contract. And so sometimes we got to help you. We need an extra bad guy to keep us moving. Do not purchase anything on credit. So let's say first clue, somebody's buying a house, there's no refrigerator, no washer and dryer, whatever it is. Just kind of maybe keep that hint if they're talking about, oh, well, we're moving in, we got to get a refrigerator, whatever it is. We have to do on certain loan types, we have to do a little credit refresh right before they close. Not a new inquiry, but just see, are they applying for new debts? Are they taking on excessive amount of debts? And there's nothing worse than seeing a Home Depot inquiry because they got zero financing for new fridge for them.
It's the Labor Day special.
Yeah, Labor Day
gotta get it
special.
done Labor Day.
Make cash deposits without speaking to the lender first. Just perfect example, we mentioned the earnest money. It happens. We try to say the same things and prep everybody. All of a sudden you got someone go, oh, well, let me get a cashier's check because I got cash at home. Oh, stop. We can't source cash. And so cash is just not our friend. And so there's some people that clients I've got with agents here that they just based on the way they grew up, they like to keep cash at the house. It's their own peace of mind. Awesome. Nothing against that. Mattress money in their safe, whatever it is, but I can't source it. And so literally we have to deposit those funds and wait at least 2 months to let it season because we only get 2 months worth of bank statements. Then they can proceed. So it's more about just setting expectations. So there's a way around it, but we don't want cash to surprise us. Don't quit their job. We don't care if they hate their job and they have future intentions. get all the way through, even the day of closing, especially with COVID, they will, we have to do a final verbal verification of employment, meaning they call and say, hey, is this person still employed? Yes, great, wonderful. Don't quit the day before. I've had a guy say he took a week off to help pack and move, and he did not take a week off. He was let go. Must keep your loop every step of the way and use this as a resource. So you go next slide. The big piece, whenever qualifying someone, obviously y'all want to talk about, hey, what's your budget? What's your max? And then also what are you comfortable with? There's basically 5 big things that go into your payment: the PI, TI. We got normal principal and interest, MI, the PMI, which is the mortgage insurance if someone's not putting 20% down. Got property taxes, home insurance, and HOA if it applies. Big thing that's, especially as the rates change, we always got to keep everybody up to speed on what someone's budget is. I gave 2 examples, Sunfield and Blanco Vista. So, part of what's going into a payment, if we say, hey, based on where this person is looking, this is kind of the max that they can qualify for. And so let's say, y'all are going to Blanco Vista and out there in San Marcos, we got a little bit lower tax rate. I think it's about 2.4 something. And so you can see of this $4,300 payment, 1,020 is your taxes, but they find a home, it's in their budget, perfect. But then, then they see the lazy river in Sunfield, and they got to get there out in Buda. And so hey, we're finding that same price point home, we're going to Sunfield. Keep it in mind, it's an extra $200. Their taxes are about 3.16 out there. And so just keep in mind, if someone comes to you and they're pre-qualified with maybe an online lender who just doesn't know the area, they can say, hey, here's your price point, and have zero idea. Some people out of state have their taxes are so much different, and so just keep that in mind. You don't want to be showing homes that your borrower at the end of the day just flat out couldn't qualify for.
What percentage makes it go up to about $100?
The taxes. Yeah, the taxes.
The tax rate.
So the $200 on that, it was difference of, I think I did Blanco Vista 2.4, and this is about 0.5, 0.6. So that's,
and what we always stress to your clients is that not all homes are created the same. So this is a perfect example. You buy a home here, you buy a home here, Round Rock, San Antonio, they're all going to come with different payments. So we encourage your clients to send us multiple options so we can show them the difference in their payments.
like our personal goal is I do not want someone making an offer on a house if I haven't sent them as concrete of a payment as I can, because it's too easy for us. Once they're in the system, you send me an address, I can pull up Hayes County tax assessor, I can pull up Travis County, whatever it is, and send them that payment, because the last thing I want to do is you spending your Friday evening, Saturday evening, 45 minutes to draft a contract, look at all pretty, and then all of a sudden we send them a payment, they go, oh, we don't, that's too much for us. And that's a lot of wasted time and effort for y'all. So we can knock it out pretty quick. So
this is why it's important to you guys, and Travis mentioned it already, is that you need to have a relationship with the loan officer, because you want to have those conversations if they're borderline on qualifying or whatever the case may be, and you're not talking, then you just set them up on the search, and it's exactly what they're saying is you're showing them homes that they can't afford.
Yeah. And we're going to get into something here in a minute about qualifying, but like if someone truly wants to be taken to their maximum mortgage amount, like normally that's a little sketchy for us, because we like to have a little leeway, but as long as we're all on the same page and we understand that, hey, maybe this approval is tight, but they're okay with the payment, then we'll move forward. We definitely are going to be very clear about how this approval is very tight. So it's all about what the client is looking for.
And what he was talking about is things that someone's pre-approval is very, very tight. There's a term called debt to income ratio. These guidelines are set by Fannie Mae, Freddie Mac, FHA, all the entities as far as what's a qualified mortgage for someone. And so there's something called your debt to income ratio. Certain loan types go a little bit higher than others. But we look at, okay, what is the person's flat out, what is their gross income? So just like he's saying, we want to make sure they're okay with that payment, because we're using their gross income to qualify, not after, all the withholdings and insurance and all those things. And we look at it, use a gross income. So this example is 70,000. So that means the person's making $5,833 gross monthly income. Their future house payment plus their current monthly obligations cannot exceed about 45%. And so this is saying, hey, they got $200 worth of credit card payments, they got a 1-car loan, So $300 worth of student loan payments, we kind of work it backwards to figure out, okay, what those debts, how much of a home payment can they qualify for? And there's, just like we're talking about, if there are someone's on the borderline of qualifying, they either qualify or they don't. And so, of course, we could be strategic if someone trying to pay off a credit card or pay off something small. You can always do those things, but those are pretty hard facts as far as the income ratio is a big deal. So, and the other term we use, loan to value ratio, basically based on how much someone's putting down, it dictates their loan to value. That's not something you always need to memorize, but based on down payment, of course, VA loans is 0 down, so you have a 100% loan to value because they're not putting anything down. When someone puts 20 or 40% down, they're at a 80% or 60% loan to value. If you ever have someone who's stuck on the thought of trying to put 20% down in this current market, just because they want to avoid mortgage insurance, tell them that that's not the normal. You can, on a conventional loan, you can put quite a bit. You can put just 3% down, but that's just the term you'll hear along the way, your loan to value. Keep that pretty basic.
Yeah, I'll take it. So now we're just going to go over type of loan types, and there's a couple of main categories, like 4, I would say. But within these 4 main categories, there are multiple options that we can look at. So once we get to know a little bit more about your client, their goals, and we can kind of start to determine what these loan types are. Ones that require absolutely no down payment are VA loans and USDA, which we'll talk more detail in a minute. Low down payment, FHA, and conventional. And then we've got what we call secondary loans, outside the box loans. We're going to talk about those as well. Those are ones that might not work for a typical bar, or maybe they got a real funky situation. We've got some other things that we can look at to try to make them a homeowner. And so now we'll jump into the actual loan types. So the first one is a VA loan, right? These are exclusively for our veterans. I mean, hands down, these are typically the best loans out there. And there's a reason, right? Our veterans earn the right to use them. The couple main highlights are there's 0 down payment, right? They can have 100% financing. It's fantastic. They'll go down to a minimum credit score of 580. And, a few of our loans will go down to 580, which sounds nice, but being, upfront with you, that's not an attractive loan offer at all. We can offer you something at 580, but it's not going to be pretty. So if one of your clients applies and has a credit score around that range, typically Tyler and I will try to give them some advice to at least get up to 620, because it makes a huge difference on the rate and fees by getting those extra 40 points. And as Tyler mentioned, there may be some just easy things to do to just help them get that 40 points. Credit scores can fluctuate pretty quickly with the right game plan. But if someone is okay with the 580 and they don't want to move forward with it, we at least have that option. Debt ratios can go up to 50% or more, like Tyler was explaining what a debt ratio is. Actually, I've seen VA loans sometimes go up to like 59%. So the benefit there is more flexibility in getting our veterans approved. It is a huge one. There is no monthly mortgage insurance. Mortgage insurance, PMI, all the same stuff, just different terminology for it. But basically it just adds on and inflates your payment. The good thing about a VA loan, again, there is no monthly mortgage insurance. There is what's called, and this is getting kind of technical on the mortgage side, but just in case you ever heard it, an upfront funding fee. Unless your vet has a disability rating, they are required to pay either 2.3 or 3.6% of the loan amount. That fee doesn't go to Streamline Mortgage. It doesn't go to Tyler or I. It's literally charged by the government. It helps fund the VA program itself. Now, this charge can actually be financed into the loan. So it doesn't have to be hard cash that your client is bringing, but unless they have a disability rating, they will be charged that. USDA loans. So they're great, but it's got to be for the right person, and more specifically, the right property. Again, 0 down payment, 580 credit score. The debt ratio, much tighter. There is no flexibility here. You're either at 43% below, or it's not going to work. 43.01, not going to happen. The mortgage insurance is fairly cheap compared to it. Other loans, they do have a 1% funding fee, which again can be rolled into your loan amount. But here's the big thing about USDA loans. And then we get these calls a lot, like, hey, I really want a USDA loan because 0% down. Well, number one, the land itself, the home itself has to be in an area that the government has censused off and said, hey, this is considered rural. So if you're ever shopping for someone, typically outside of the Austin area, we can definitely look for USDA loans, but we literally have a website that we go in and plug in the census tract, and it will tell us if the home is USDA qualified. Sometimes it's seriously like one side of the street is and one side of the street isn't. So it's very precise on what area will be considered USDA. Another major requirement is you can't make too much money based on the county you're trying to buy in. It's income restrictive, and that is household income. And what I mean by that is if partner A applies and partner B doesn't apply, well, we're still going to count partner B's income. So we have to add that in to make sure that they don't go above the household income. Even if they have an adult, son or daughter working, like sometimes that income, and they're living in the house, sometimes that income has to be counted as well. So I bring that up because these are very technical loans to try to get your clients approved for, but for the right person and for the right area, they're fantastic. FHA loans, really popular loan. This is a government-backed loan, been around for 50, 60 years. This loan, again, will go down to 580, but we want that 620 is what we're shooting for. Typically, FHA loans are reserved for people who maybe have a little bit lower credit or maybe a little bit more debts. They offer some flexibility in the approving. The minimum down payment is 3.5% of the sales price. The monthly mortgage insurance is 85% of the loan amount, or sorry, 0.85% of the loan amount. And what's nice with that is the mortgage insurance is one flat rate, meaning that whether you have a 580 credit score or an 800 credit score, you're going to get charged the same amount. So sometimes that is the determining factor of why we go FHA, or if you apply as someone and we tell you, hey, they could, maybe get qualified for conventional, but an FHA is going to provide a better payment. And we'll jump into those scenarios in a moment. This one has a 1.75% funding fee. Again, that's charged by the government to help fund the program. It can be rolled into the loan amount, so it's not a hard cost out of pocket. Major thing here is each county has loan limits for FHA. So currently, and these change annually, sometimes twice a year. Currently in our surrounding counties, it's around $483,000. So what that means to you is if you have someone shopping above this range, FHA is not going to be an option for us.
And is FHA only for first-time home buyers?
Oh, that's a great question. It is not, no, but you can only have one FHA loan at a time unless there's some really extenuating circumstances. Like maybe your client had an FHA loan in Colorado, but got relocated to Austin for their job. Well, then we could potentially look at another FHA loan. That's not our call. That's an underwriter's decision. They're the ones who approve the loan on the back end. As loan officers, we're basically like underwriters because we're trying to make sure your clients can get approved for everything. But whenever we send a file on, we want to make sure that the underwriter is going to approve everything. But typically one FHA loan at a time. Do not have to be a first-time home buyer.
Amber, you won the award, best question
Yeah.
already.
I know.
Yeah.
Well, I got that question recently, and so I think it just stands to reason that
Yeah.
it's a common question.
It is,
So.
yeah. And then the last kind of major loan category is a conventional loan. Your minimum down payment can be anywhere from 3 to 5%. 3% is reserved for first-time home buyers. And in our eyes, when I say our, mortgage rules, a first-time home buyer is someone who has not owned a property in 3 years. So that's cool, right? If someone had owned a house 4 years ago, but they sold it, well, then we could get away with a 3% down payment. The minimum credit score here is 620. I will tell you that if your client is applying with us at a 620, we're probably not going to go with a conventional because this payment is going to skyrocket. And I'll get to that in a second. The maximum debt to ratio is typically around 45%. We've seen it a little bit higher depending on other circumstances, but definitely no more than 50. Was that a question?
Nope.
Oh. And here's the big thing with conventional, loans compared to others. So all of the other loans we talked about had a set mortgage insurance rate, so we can figure out your payment. On a conventional loan, it's based off of your down payment and your credit score. So what I mean is if someone put down 5% as a down payment, well, their mortgage insurance is going to be, a little higher. If they put down 10%, it's going to be a little cheaper. 15%, even less, and 20% down payment has no mortgage insurance whatsoever. I did that in 5% increments because that's where the adjustments happen. So sometimes people come in and like have a set amount that they want to put down as a down payment. We work in percentages. So if like someone was trying to put down 7%, we would probably recommend them to either go down to 5 or go up to 10. That 7% is not really going to make much of a difference in their loan terms. But also the mortgage insurance is calculated off your credit score. So even though we can offer someone at 620 a conventional loan, and if they, compared to an FHA loan, their mortgage insurance is probably going to be about 3 times more expensive, which crushes their payment, right? So a lot of times the payment is what it's all about. So having good credit and a down payment will influence this PMI, so you can get the best payment. The good news about this is that the conventional loan is the only loan that the mortgage insurance will eventually fall off on. And so what I mean is, say someone comes in and puts 5% down for their initial down payment. Well, as they make payments, over the month, they're going to own more of their home because they're applying towards their loan. But also your home value is going to go up as well, right? Typically, in our area, our homes are going to go up. So after a while, they've got the option to either refinance or even just come see us. We can do some stuff behind the scenes that, once their value equals that 80%, we can get rid of that mortgage insurance for them. The other loans I talked about, FHA and USDA, those are on there for the life of the loan. They're never disappearing. So our game plan for people with those other type of loans are, okay, maybe we need an FHA loan for you today to make you a homeowner, right? But this is not where we're going to be for the rest of your life. We're going to look for a better financial tool later on, which would eventually be getting someone to a conventional. Other than the VA loan, the conventional is typically your best financial tool to buy a home. But the conventional does have loan limits. Just recently, it's gone up to 715 in our county. Pretty good increase from where they are. If we go above this, and these are loan limits, these are not purchase prices. But if our loan ends up above 715, we're going to look at other options called jumbo loans. We're not going to spend a lot of time on jumbo loans, but just know that we do offer loans for balances above 715.
You kind of brought it up, and since we're talking about interest rates and things are crazy right now, I think so I get into a loan, doesn't matter which one. So am I committed to that loan for the term of the loan?
You ever seen a Sandlot?
Yes.
Forever. No, so you're not. There are no prepayment penalties with us at Streamline, meaning that if you we close on your home today, and then 12 months from now, rates are much better, you can refinance with no penalty. And, we actively work with our previous clients to make that happen, right? There's no reason to stay in a high interest loan when we can save you some money. And the difference between, yeah, go ahead.
Are any of these assumable loans?
As in like someone else take it over?
Right.
No, not really.
Do we offer that?
Not that I.
So only government loans are the ones that can be assumable. I've been doing this like almost 10 years. I've never seen someone actually do an assumable loan. It's got to be another government buyer trying to buy that house. And I know it's becoming I see these little TikTok videos of people trying to advertise those kind of things. It's a lot. I don't.
Is it more so like private entities that offer that?
No, it's more of it's a government thing. I honestly don't know the rules as far as, it's got it. Let's say if it's FHA, like conventional it's not assumable loan. FHA, if another FHA buyer is buying that house, but it's an approval process because the person buying, you can't just, hey, take over the mortgage because you can already see what it takes to get qualified for a loan.
So I have a listing that I'm making an offer on, and we just found out that it was an assumable loan through their mortgage company.
Okay.
So I just wanted to know if we offer that.
I think it wasn't as popular before because rates have been so low and they probably wanted to get their own loan. Now that rates are higher, we may start seeing more. Give us some details after class. We'd love to look into it.
Okay.
And
I
we'll be
just
the
don't know how it works. That's
yeah,
all.
and it's not something we have seen in our recent markets because we were at, historically low rates during COVID. That's not where we're at now. But going back to your question, as far as like, do we have to keep the loan forever? No, we don't. We're gonna look for some options, but let's definitely catch up and talk about the
Okay, cool.
situation and what we can, do for you.
Were you meaning as if you started off FHA, but then decided to go a different loan?
Yeah, I mean, you answered both of them
Okay.
though. Yeah, like you're not, I enter into a 30-year loan. Do I have to stay with this 30-year loan for the life of this loan?
No, when we refinance someone, there's everyone that looks to refinance may have different goals. Maybe it's, hey, I really want a cheaper payment. So I want a lower interest rate and I want to reset my term back to 30 years. Or hey, I want to get out of the FHA loan and go to conventional. Or you know what, actually, I really want to pay this loan off sooner. Maybe I want to go to a 15-year loan kind of thing. Or hey, I've got a lot of equity in my house and I want to take out, some cash for a college fund or add a pool or go on vacation. So multiple reasons of why someone would look to.
And that's why
refinance.
it's good to mention too, because with rates as they are, if someone is needing to get into a home, that's the talking point, right? It's like, you're not committed to this for the 30 years, like we'll get you out of it as soon
Yeah.
as we can, right?
And
Hopefully.
yeah, I know everyone is seeing like what, marry the home, date the rate or
Yeah,
whatever.
mhm.
Yeah, cool.
All that stuff.
Yeah, but I mean, it's true. A mortgage is a tool to provide someone to become a homeowner. We are going to proactively look to try to improve their situation. Because if your interest rates are going up, you better believe your rent's probably going to go up too, because you're paying you're paying your own mortgage, or you're paying someone else's mortgage. There's no way around
Good
it.
question. So there's no fee for refinancing. What about if somebody wants to sell after 12 months?
So so we don't have lender fees, like which is one of the things we loved about Streamline. We don't charge your people money to do loans. Now, refinancing does cost with certain loan programs, like we may need to get a new appraisal. They'll probably have to get new title work because the loan terms are changing. The good news about that is title is kind of a set price throughout the state of Texas. So like one title company can't charge you more than another title company. It's also on a sliding scale, meaning that, within 7 years, you get a discount. You get one discount, like a big discount if it's been 2 years, a little less 3, and so on. So not a ton of fees like you would see normally for, purchasing. But what was the second part of your question? After 4 months, I think?
No, 12 months.
Oh, yeah.
Instead of refinancing, if someone wants to sell their home.
Yeah, that's no problem. We have no prepayment penalty. Yeah.
Yeah. The only thing to add to what he was saying about like no fees and whatnot, I was gonna put this at the end of the whole presentation, but everyone's getting solicited on different things, so you'll probably see all kind of marketing thing. And actually, one of my realtors, I'll leave a little early to go to the closing today, but he was like, "Hey, man, y'all doing free refis?" Because I see a lot of people advertising free refis, and so I joked. I said I saw another lender. I said, "You read on the bucket, it says free refi, but it says credit up to $1,800 off." Lender fees. And so I said, well, it's not free. I said, I guess ours is free to some. We don't have lender fees as it is. I said, but it's never free. People still have to pay title fees, appraisal fees, the third party stuff that it just happens. And so I was joking a lot. I feel like everyone's trying to get a little unique on what they're marketing, how they say stuff.
Mhm.
I told them, I was like, that's just not the way. I don't like to.
I've seen several builders offering that, like free refi within 18 months.
Yeah, and so like it's not free. I mean, I guess how it gets done. But
Ain't nothing in this life for free.
And yeah, and on that note, if you ever, like, whether you're working with us or not, like I mentioned, like, we're a resource for you. Like, treat us as, someone who can help you out. If you ever have something from another lender or, your client, you just want to run by us for a second opinion, like, we're here for you. Like, we're not going to, hard press you to say, hey, bring us over the loan. We want it. We want to earn your business, but like, we're also here just for advice as well. Oh, this is definitely you. Yeah.
So the down payment and closing cost assistance, there's obviously we've been doing down payment assistance program for like the last 5 years now. And so they are, once again, just like anything, they are a tool. They're not always the end all be all, answer for everything. Basically TSHEC is kind of like the most popular one. There's TDHCA, there's a few different ones, but at least TSHEC, they're the most flexible and had good success with them. you can, it's all, if someone's shopping us for DPA programs, it's all public information. We all have the same rates. So I kind of like to tell people that it's no secretive thing. You can literally Google T-Shack interest rates and you can see what's on there. They offer assistance in the form of a free grant, or it's what they call forgivable second lien. The grant, obviously, it's a grant. You don't have to pay it back. The second lien, basically, they can sometimes give you up to 5%. So let's say if someone's doing an FHA loan, you have to put 3.5% down. They can technically give you up to 5%, but it's in the form of that lien. So that the day you close, they got the normal mortgage, you've got this little extra piece of assistance. However, after 3 years, it goes away. Basically, the goal of their program is that way somebody doesn't go buy the home and immediately refinance and they lose that money, but after 3 years, it goes away. So like assistance up to 3 to 5% of the loan amount. Their minimum score is 620. If you're above 640, it saves you a little bit of a fee that they charge. So that's always the goal. There are income limits, just like anything, but pretty high. And here in Hayes, Travis, Williamson, Bastrop County, I think that's 118, 113. And the reason I say they're pretty flexible is, I don't know if you remember, he was talking about the USDA. They want to know is your grandma living with you getting Social Security, your son working at Sonic, whatever it might be. They use qualifying income, meaning if one borrower makes 100,000 and then the other person makes 200,000, but we don't need them to qualify on the loan, they don't care. They look at what we're using to qualify. There also is purchase price limits. They're still pretty high. To me, it's an okay balance as far as because there are income limits, the persons who can stays under that threshold is not going to buy a $700,000 house. And so it works out. They do have normal standard program fees. What I want to bring up big time is that the part of just having a working relationship, always communicating with y'all. As this crazy interest rate market has been, this program, they have to figure out what rate they want to set stuff at. They're always normally about 1%, some of 1.5% higher, but it's not a secret. It's an education to tell somebody, hey, this is getting us from A to B, but their assistance. So it says 3 to 5% as the market shifts. Sometimes their 5% option goes down to 4, and then sometimes their 4 goes down to 3. We had about 3 months ago when the market really started getting wild. They basically all went away. They basically hey, we don't know how to price these products, so they just went away. And so what Rizal mentioned about communication wise, I think I had about 5 or 6 people shopping with realtors I've had a good relationship with for a long time. They've been looking at homes out skiing. They've been driving all around to find these affordable homes. All of a sudden the next day, I didn't have a loan option for them, so I immediately, not making fun phone calls, but just telling, hey, realtor, hey, stop showing them houses. I don't have a product for them right now. Letting the borrower know, hey, and that this product's come and go. So maybe tomorrow we'll be back at it. But so those are just things that this is all a tool, but we always want to have a backup plan and communicate with somebody that we don't set this program. We don't, it's a third party person. So we just got to always keep that in mind. But
yeah, and what I would say for y'all to take away from this, we definitely wanted to give you an overview on it. But if you are talking to your clients at initial consultation and they say, I just don't have enough, for down payment yet. Well, okay, some lenders that have a down payment assistance option. And we'll go over all of this with them. As Tyler mentioned, you have to have a special license to offer T-Shack. You could actually find our names on the website as preferred lenders. So not every lender offers this specific program. We just happen to have been doing it for 6 years now or so. So for the right person, this product is fantastic. Yep.
So I've been hearing, down payment assistance had gone away and then it's come back.
Mhm.
How does that happen? Where it just goes away?
So kind of like what Tyler was mentioning, the rate market, typically our interest rate market, moves very slowly in either direction, right? And so the people who are on Wall Street or behind the scenes at T-Shack or whatever that predict where rates are going to be, have a pretty good understanding of what things are going to do. This in June, things got wild. Even now we're at a pretty high rate environment. So when they don't know what's going to happen day after day, they just they have to protect themselves. So they just suspend the program for a moment. Now, when that happened in June, I think that was maybe the first time we've ever seen it happen in the
Ever.
6 years we've been doing it. And it's actually going on right now today. Like there's only up to 3% assistance available. I'm working with a couple clients on it, but that doesn't mean it's not going to be back tomorrow, kind of thing. So for you, I wouldn't worry so much about like what is available and what's not right now, and let us kind of handle that, like talk about it. But you know, I would say the number one thing we get from your applicants, and when I say you, I mean everybody, is how much money is it going to take to make me a homeowner? Like, what have they been saving? Like, I've been trying to put away. So a lot of times this product is a great way to make someone a homeowner who just hasn't been saving enough or doesn't want to deplete everything they have been saving. Because we don't want to see that either. We don't want to use every last penny to make your clients a homeowner. Like that's not what we want to do.
So I think that's a great a tool to have.
Absolutely.
But if something like that were to go away, say, for you guys, is there other DPAs that are available for other lenders at the same time?
Yeah, there's a couple others out there. I mean, I only say these names just in case they, you know, you hear them. There's one called Seth. There's one called TDHCA. They're experiencing the same thing. We are, I mean, I truly believe T-Shack is the #1 best. It's definitely the most popular in Texas. The fees are the lowest. The assistance amounts are the best when everything is normal. There are sometimes things we can do on our end without this kind of program to help out with closing costs as well. We can get creative on our back end, but it really just all comes down to the goals of your clients, right? But definitely know that there are some assistance programs out there. And then hopefully within the next month or two, like we won't have this conversation about it not being available. Like things are gonna like steady off. But I mean, if y'all watch any economic news right now, things are a little wild.
Yeah.
So, you know, and that won't be like that forever. But just today at this class, a little sketchy. Yeah. I'll take this one. Yeah. So as I mentioned, we were talking about those 4 main categories of VA, USDA, FHA, and conventional. We call these secondary loans, kind of outside the box. The official terminology, we put this up here just so you'll, you know, if you ever hear it, called non-QM. QM actually stands for quality mortgage. But these are products that can help more clients become a homeowner. And so a couple main categories here. The first one is called a bank statement loan. So instead of us taking, you know, paychecks or W-2s or, you know, some traditional way to come up with an income method, we ask for bank statements. And normally that's either 12 or 24 months of bank statements. So we literally go through each bank statement and see their income deposits and then have a calculation that we can come up with to give them income for. And a perfect example is someone I'm working with right now, was working with their local credit union. They're a small business owner. And in 2021, they had some major like paper write-offs, right? And if you know anyone who owns a small business, you can understand like how they do their taxes. And you know, we're not the IRS, right? We're not the government. How you do your taxes is your business, but sometimes small business owners write off so much stuff that their income is affected by it, and it affects their approvable, you know, what we can do. So this is a different way for us to come up with income. But going back to my example, they were denied at their credit union because they just could not come up with an income figure that would work for their debts. So they were referred over to me, literally went through 3 different accounts, 24 statements for each account. Well, it took some time, but when we got done with it, we were able to come up with $33,000 a month for income for them. So now they've got a product to become homeowners. So another great way to make someone a homeowner using a non-traditional method. Another option is an asset-based. This is using something like a savings trust or retirement to come up with an income figure. Earlier this year, I helped someone who inherited a trust from a family. You know, it was millions of dollars, but they didn't have a job and like, you know, kind of reportable income, or they had a job, it just wasn't what we needed. So we were able to use their trust to come up with an income figure and help them buy like $700,000 home. So another way that we can, you know, make someone a homeowner. This one is a little bit different. It's called DSCR. It's been pretty popular the last year or two. So it's used for more on investment purchases, but basically the way we get someone approved, it's not income based. It's based on what is my mortgage payment gonna be and what is the rental income gonna be. And as long as the rental income matches or is greater than the monthly payment, we can typically get an approval for them. So if you got any investor clients that are just looking to buy some properties and maybe their cash flow is a little low, or they've got income things like we just talked about, this is another way that we can talk to them about making them a homeowner. Full disclaimer, these are great products. These are fantastic. They give more options to help people out. They typically come with a little bit higher interest rate. I would say about 1 to 1.5% than your conventional FHA loan. But for someone who needs it to become a homeowner, they don't care. And we always tell this to our clients that Tyler and I are not compensated off an interest rate. Whether someone gets 1% or 20% interest rate, that doesn't influence how we provide for our families. So we're just going to look for the best product. And also, like I mentioned, give them tips to maybe even get their credit score up higher to give them a better interest rate. So just always like to throw that out there, even to your clients sometimes, because they might not know that, we're compensated by helping them get into the home, just like you are. That's how we're paid.
And going back to Amber's comment, it's not the loan forever. So let's say today, because of how they've been reporting their taxes, because maybe COVID, they had pretty rough last 2 years, so they just didn't qualify the normal route. Well, okay, maybe they had a little higher interest rate for the first 12 months or 2 years. Well, then you try to refinance once you get your finances back to a new normal, without the write-offs. But so it's a tool, like I said, just help you become a homeowner. So
And how many months of rental income qualifies you?
So this is actually based on the projected rental income. So I did one of these earlier this year. It was out in Round Rock. It was actually for a friend of mine. And so when we figured out his monthly payment, right? And what was wild on the one I'm talking about, he actually used Bitcoin for his down payment, which was a first for me. Yeah, like these loans don't have the standard guidelines of the other loans. I would say if we help 100 people, maybe 3 might fall in this category. So they're not everyday loans, but they're out there. But to go back to your question, so my buddy, bought a home, he put down his money with Bitcoin before it crashed. So we had a mortgage payment for him, based on taxes, all that good stuff. Then we get an appraisal, and the appraiser goes out there and says, okay, the market rent for this area is, Y amount of dollars, right? And so that rental was, just slightly higher than what his mortgage payment was. Cool, we're approved, done.
Okay.
Yep, we didn't deal with it because he was a small business too. He had just started it. We didn't have that income for him, but this was a way to make my friend a homeowner. Yep.
all right, this next one, this is a slide we just added because just like as the market's always changing, I guarantee you, if you haven't already, you're probably getting solicited somehow, shape, or form about a temporary buy down. If you see anybody saying, hey, instead of negotiating $10,000 off the price of the home, see if you can negotiate seller concessions, this and that. It's happening. Everyone's trying to get unique. I don't know if we're talking about just streamline in general, but we are a broker. So obviously we've got just like all these different loans. We shop around a lot of different lenders, different products. A lot of them are doing these same type things. So it's not like it's one unique deal. What it is, and this is actually an example I did, I think on Monday, for someone buying, it was a $445,000 home. They're putting 10% down. What it does is you can, it's just, we have a basic Excel spreadsheet. So you'll have to ask us if someone's trying to negotiate how much you need to try to get. The funds have to come from the seller, so it can't be self-funded by the borrower. But I literally plugged in the loan amount, the interest rate, 6.99, which kind of stings, but it is what it is. It's got the normal, 30-year normal payment. The first 12 payments, so the first year, it takes 2% off of the interest rate. And so that literally saves the borrower $514 a month, and which is equivalent to $6,000, $661.70 that first year. Year 2, it goes up 1%, still saving them $263.16 a month, which is another $3,000 just in that 12-month span. Year 3, it goes back to the original rate. This is not an adjustable rate, mortgage, anything like that. We have to qualify them all normal debt ratio and this and that at their normal rate. It's not a surprise what their rate is. Like they know, hey, this 6.99, this is your rate, but it gives them temporary relief. the positives to this is on this example, that means, or little thing, but $9,328 has to be negotiated from the seller. So the agent that I just chatted with, I said, hey, instead of trying to get $10,000 off the price of the house, see if we can get seller concessions of at least $9,400. So that's how they structured the offer. The nice thing about this is that money gets set into an escrow account, just like their normal taxes and insurance. And so that escrow account is kind of helping pay it, supplement it every month. If in 12 months, all of a sudden the rates market comes down, we can refinance that money. It's in an escrow, so that gets refunded back to the borrower. So it's a tool for someone. It's not every house. If you've got a home that's, in a great little area and it's priced right, are you going to be able to negotiate, $9,400 in seller concessions? No, but I promise you, if you hadn't already, you're probably, someone's going to send you an email about a 2-1 buy down, structuring your offer in a different way. And so at least we have those tools. And that's kind of like a new thing that started about 3 weeks ago. One of our investors does it, and another one was doing it, and another one. So it's just a tool.
What I'd say for that too is if you guys are seeing homes that have been sitting there for a long time and they haven't done a recent price drop, then you might be able to go and talk with your mentors or talk with Carlin about how you're going to talk with that listing agent about presenting this, because it is something, hey, we're asking for concessions, but hey, we were either going to come in at this price or come in and ask for these concessions so we can make this happen. So.
And feel free to reach out to us if you ever want to talk about how to structure a deal. Maybe we talk about closing credits or offer a little bit more, and we're, here to help you, again, as a resource. As Tyler mentioned, this is more, I would say, a product that is like market driven. Like there was no way 6 months ago you were going to get any negotiations from the seller, right? Like you were bidding $20,000, $50,000 over, or if you were with a home builder, you might have been one of 30 on a list waiting for a lot kind of thing. So this is a market driven product, but definitely something we offer. And if you hear it out there, we may suggest it when we're doing negotiations with your clients.
Does the seller have to qualify at that 699 rate though?
The
Like,
buyer.
No, it's the buyer.
Correct.
Yeah, absolutely. That's why I was saying it's not an adjustable rate mortgage. They are getting a 30-year fixed mortgage at 6.99. They just have this little
They've
special.
got to qualify for that.
Absolutely. So it's not a surprise, unique. It's not, we're not back into the crazy world of the subprime market, all these crazy arms and stuff like that.
And not to get too loan officer-ish on you, but there are things called adjustable rate mortgages out there, which we offer. Technically, they're not that great right now, but we always have to qualify someone on that product of like, what's the worst case scenario it can go to? Not what's the nice attractive for the first 2 years or whatever. What could it potentially go to? And that's what we have to qualify someone on.
This is just giving someone temporary relief, but who still can qualify for that, but just temporary relief in hopes that next 2 years. Right? But if it doesn't, there's no money lost, which is kind of a nice thing, because you can still pay points to buy down an interest rate, but it costs quite a bit to buy down your interest rate that doesn't do a whole lot. So this is just like, once again, just a tool that I just want to make sure everyone knows that we've got it too. So
I'm thinking,
Sure.
do you need to run your thing?
kind of do.
Okay, yeah, Tyler's heading to a closing, which is one of the perks you get. Like we try to attend as many closings as possible. So, yeah.
Thank you.
I will definitely gonna put my glasses on. All right, so what happens after you make the referral? So we try to reach out as soon as possible, but typically no later than 24 hours. We understand how valuable a referral is. Like, and we appreciate, you giving us a chance to try to work it. So at the very least, we're going to reach out to your client and, introduce ourselves, whatever, that might look like. As far as how we talk to the clients, totally up to you. If you want to connect us by text message, by email, come in our office and give us a phone number and we'll call. No worries, we're flexible. I always like to start with a phone call, even if you introduce us by text or email. There's just so much to talk about in the beginning that, emails can get wordy, so can text. So I always like to say, hey, let's have a quick chat. First, the question I always ask is, let me hear a little bit about you, right? What's your goals? What's your timeline? Where are you wanting to live? Have you ever bought a home before? I try to talk about, your client first before I start talking about me or mortgages. Then ask them if they have any questions and then give them a little overview of the lending process, which typically is after that phone call, we're going to advise them to start an application. An application is going to give us the tools and the info we need, and also the legal, authorization for us to do what we do and get them pre-approved. Y'all all know we need to get your clients pre-approved. You don't want to be spending your weekends, taking your people out looking when they're not ready to, or not able to buy. So our goal is to get someone pre-approved. When a pre-approval is us reviewing financial documents, it's reviewing a credit report, it's talking to them about their game plan to make sure that the payments where we need it to be, and asking any potential questions that might, come up. As in, oh, hey, Mr. or Mrs. Client, I see that you listed that you're separated on your application. Are you going through a divorce? Well, I sure am. Well, okay, well, maybe we need to let that divorce, finalize before we move forward, kind of thing. So all sorts of stuff on that app that are like triggers for us for questions, kind of thing. So we'll work to get them pre-approved on a pretty straightforward situation, one that's not, like I said, 64 bank statements that I went through, can be as quick as 24 hours, after they apply. And then what we like to do is get them back in touch with you as quickly as possible. Whether I call you and kind of give you a heads up, or maybe I connect y'all back by email to kind of give an outline. And then, how I typically operate is create custom pre-approval letters. So, for this specific property you're looking at, if you need one just for generic purposes, just to have, we'll certainly do that. But when you need custom, just holler at us, get them back to you so y'all can go start looking for a new home.
I have a question.
Yeah.
How long are the pre-approvals for?
Great question. So, couple answers there. One, no one ever has to apply again. Once they apply, they're good. So the pre-approval is as good as long as the credit report is not expired. We operate a slightly different. Normally, if you were to refer me someone today, I'm going to pull what's called a soft credit check. And that's what's done, like if you go get a cable bill, or if you go get a cell phone or whatnot. That's not a hard hit on their credit. When we pull the credit report, that expires within 90 to 120 days, depending on what product we use. So, if you gave me someone today, right, and we got them pre-approved, and then by, February, they're like, okay, no, I think I found the right house. I'm probably going to refresh it, right? Make sure like nothing's changed or whatnot. So they don't typically like expire, just some of our documentation on the back end expire. Does that make sense?
Yeah,
Cool.
and the reason I asked, I have my buyer, she's in a lease right now, so,
Okay.
she's still got that 6-month wiggle room, but that's
Cool.
what I'm asking. So are they gonna take like longer to, because I feel like she's just taking her time to fill out the application.
Yeah,
form.
so that's a great, I'm glad you brought that up. This is a good talking point. So I always think it's never too early to get your pre-approval, right? Now, if pre-approval has dust on it from like a couple of years ago, we're gonna need to look at it again. But, I have this conversation with clients all the time saying, okay, your lease is up in 6 months, right? Well, we can get you pre-approved now, but when it becomes month 3 or 4, that's when you need to start shopping, because you don't want to be put into a tight time frame and have to settle for something. But then also, like, what are we in? We're almost in October. So say someone finds a home in October, well, that's a 30-day process from by the time the seller and y'all come together at the title company. Well, so say we find the home in October, we close in November, the first payment doesn't start until the following month, so January. So I always bring that up with your clients, because if they're in a rental situation, trying to avoid getting double dipped from the apartment or wherever they're at in the current mortgage payment. And also, like, just from experience, like having some breathing room makes this so much easier and less stressful. Like, there's nothing worse that someone is panicking that they've got to be out of their place or needs a house by Thursday kind of thing. Like it's nice to have some shopping room. And then also, just like a mortgage or just like a real estate contract, anything can happen. Or sorry, just like life, like anything can happen in your in your contract, right? What if the appraisal comes back low and the seller's not willing to negotiate, and you got to start all the way over again? So having that flexibility is great, kind of thing.
Thank you.
Also, if anything comes up that they need to work through, they have time to maybe bump their credit, the 20 points to qualify for a different program that's
Perfect
better.
example. Yeah. And like on that note, like, we just started teaching a credit 101 class. I thought it went really well the other day. So next time we offer it, sign up. But if someone applies with us and they just don't have the credit we need, we don't just get rid of them and shoo them. Like, again, we appreciate and value your referrals. We'll put them on a plan to get that credit score we need to be. So there are, countless people that we have worked with where they weren't where they needed to be. We gave them a game plan. They put the effort in, whether that was 3, 6, 12 months or more down the road, come back to us and we make them homeowners. And quite honestly, that's our industry can be a grind. Like your side, our side, it can be tough. But those kind of stories are so rewarding that people put in the work. You gave them a game plan. They're so thankful. They never thought they were going to be a homeowner before. And that's what kind of keeps us going. So never too early to start on an application. It doesn't cost your client anything, doesn't commit them to anything. It just at least lets us get a game plan together.
What if they were approved in a different
No.
state?
Oh, different
Would we-
state?
Yeah, would it be best to get that approval from the lender they used before?
So I'm not gonna use any lender's previous
Okay.
information. I'm gonna do my thing.
Okay.
Yeah, absolutely. Now, it's cool that they got it and maybe tells you that they're, qualified, but that lender may not be qualified to lend in Texas. Now, if it's a big, national operation, maybe, but as a licensed loan officer, it's state specific. So if they're using their local bank in Oklahoma, California, wherever, more than likely that loan officer can't lend in Texas.
You might be covering this, but talking about when you give them to us back with their pre-approval, then before we're writing an offer, what conversation should we as agents be having with you as a loan officer?
Yeah, so, always call us when you're talking about an offer, right? We're gonna talk about the purchase price. We're gonna make sure that, and great point, say we got someone approved 6 months ago, right? And then they just disappeared, right? They just took their time, but then they came to us today. Rates are not what they were 6 months ago. They're not. So we need to readjust expectations on the payment, make sure the pre-approval is good. Make sure nothing has changed within their employment, all of that good stuff. But we're just gonna, have a talk about, expectations and timelines as well. Typically, we need 30 days to close a loan. They can be done sooner if we need to. Let's just talk about that. If it's a longer approval or a longer close date, let's talk about that as well. If you're offering what's called a lease back, let us know on that. There's guidelines on that. So there's all sorts of stuff we can talk about, inside the contract to make sure, we're, together on this. And more importantly, that we're on the same page for your client. So they know that we're a team and we're gonna make this happen.
You never want to be writing an offer and just you assuming that something can be done that you have no control over is the point.
And that's why I like to, when I mentioned, I like to give you a custom pre-approval letter. I like the pre-approval to match your offer. And I like the pre-approval letter to have the same day you were submitting the offer because it looks clean. And honestly, there's no reason for us to disclose to a seller what your buyer is pre-approved for. I put what you're asking. Because say you're trying to go in and negotiate this home right here for $400,000. What if we think we can get it for $390,000? Cool, right? But if your client's approved for $500,000, that's not the seller's business. They don't need to know that. So we can send you a letter for whatever you're trying to offer.
What do y'all look for as far as work history? What?
Ooh, yeah. So the easy general rule is, you can go on to the next one. So typically we need a 2-year work history, right?
There's a gap in between 3 or 4 months.
3 to 4 months is doable. After 6 months is something we would need to address. Also dependent on the loan program as well. There are some guidelines and things we can work on. A perfect example is working with someone who just graduated from Texas State, got an engineering degree. He's now working at Tesla. He hasn't been at Tesla for 2 years, but he's got a certified degree that helped him get that job at Tesla. Cool. Used college transcripts. We're good to go. Question?
What if they're on workman's comp and technically they're getting a slightly lower paycheck than they normally would be?
I'm going to repeat that too. So she's asking about if they're on workman's comp and their pay has been reduced. Sorry. What was
So
your-
that's a couple layers. Number one, that reduced pay could affect their ability to get approved, right? Because we don't know how long that workers' comp's going to use. The easy generic answer would be, we would probably want to wait till they're done with workers' comp.
Or what if they have a second income? Is that
Great question. So I consider a part-time job kind of thing, or?
totally separate full-time career?
Okay, so people that have multiple professions, normally we see that as a part-time job, but if they have 2 full-time jobs, typically we want to see a 2-year history of that second job. Meaning that you can't just, go get a job somewhere else tomorrow or start driving Uber on the weekend, like next week, and us be able to count that income. But if they truly have had 2 jobs for 2 years, heck yeah, we're gonna count that income for sure. Yeah. Did that cover your question about what I don't remember what the question was now?
Joe asked.
I think that covered it.
I feel like it
Yeah.
did.
Yeah, so again, I'm Travis, my boy Tyler, like we've been working together forever. I just want to, reiterate, like, we are here to help, and, whether that's with your own clients, whether that's just advice for, someone else you may be working with, we're a resource. There's a reason Carlin and Chad brought us over. They've known us for quite some time. We're here local and we're just, here to help. So
So it
we
doesn't matter who we send it to, y'all work together.
send
like-
me all the good leads and Tyler all. no.
They both do their own, and
Yeah.
so,
No, I mean, what we typically find is that, people, may gravitate one towards the other. You're not gonna hurt our feelings. It doesn't matter. If I'm tied up to something and I need Tyler to, work on it, I certainly will. If you're working with Tyler and he's, dealing with one of his 3 kids on the weekend, but you need a pre-approval letter, then he's gonna text me and say, hey, Travis, can you knock this out for me? So, but, your clients will typically work with just one of us. We're not going to confuse them on, are they working with Tyler and Travis or whatnot, but we're both here to help you.
Hey, Travis, I heard Tyler mention that you guys were brokers, so you actually deal with different lenders.
Yeah, so great. That's a great question. So just to give you a quick brief history, Tyler and I met at a local credit union here in town, which was, really nice to work at, but they had some limitations on their mortgage department. They're a conservative credit union. So from there, we went to what would you consider like a true like mortgage entity, is Guild Mortgage. You may have heard of them. They offer what Guild offers, like their own in-house. What Streamline is considered a broker. So we've seen all 3 worlds. And the difference is that we have like 10 to 12 different entities we can go with and secure your financing from. And the advantage there is number one, we've got all those people competing against each other for interest rates. So, they have to be competitive. And 2, it gives us more options on what we might need to do. So we know like, okay, option 3 is great for this client because that person takes these kind of tough loans, or they can be structured a little bit different. So they will always work with Streamline Home Loans. So whether we go with option A or option, Z, whatever it may be, they'll never speak to one of the entities we're securing their financing from. It will always be someone, myself or Tyler, or one of our employees at Streamline Home Loans. Cool. No, that was a fantastic question. Cool. So, yeah, y'all come holler back in the sweatbox back there if you ever need us. And last thing I'll say is, I know I mentioned it multiple times, we're a resource for you. That's not just loan questions. We've helped create some of these open house flyers. If you ever want to do a short video for your clients and post it out on, the Gram, Facebook, TikTok, whatever, we can set up a time to go in there and do a little, first-time homebuyer segment or a down payment assistance segment. Like literally anything we can do to help y'all, we're there. If you ever have any sponsorship opportunities, I think we have something coming up in the Fitzhugh Brewing in Driftwood soon. Maybe. Yeah. Anyways, Chad's team, we're helping out with a little sponsorship thing for the Halloween stuff. But again, like whatever we can do to provide value to you to help you, we're here for. And maybe see y'all at the happy hour later on today. So, yeah, cool. We'll have cold one.
Thank you, Travis.
Oh, and I'm originally from Florida, so I've got some fresh saltwater taffy, best taffy you've ever had in your life. Please come help yourself. Multiple flavors, and just appreciate y'all coming.
Thank
Yeah.
you.
Look at that timing, Carlin.
High
Going
five, good job, Travis.
What's up?
right from lending to CMAs.
Tag out.
Right?
Yep. All right. now
I need to go to the restroom, but I'll
Okay.
come back.
Yeah.
All right, I am going to jump in. Or. How was that? Good, helpful?
Good, very good.
Good. I learned I can't be in here for those because I keep
interjecting and slowing it down. I'm like, I'm just gonna stay away. He knows what he's doing. I'll let him do his job. All right, I'm gonna jump into our book. Seaman. Okay, oh my gosh. I could put it out there. We still have like desserts left over from yesterday, and then I've got cake coming for happy hour. All over. All right, so we're gonna work on listings next week, but we're gonna work on CMA today. We're talking about CMA and appraisals. We're not gonna get into the appraisal side, but I want to practice some CMAs. And then we are on page 42. So we got CMA and then I'm in MLS. Okay, perfect. So as an agent, we do not get to perform an appraisal. Only licensed appraisers can do appraisals. But it's really important we do know what they're doing, how they do it, so that we know going in when we write an offer if we're going to make appraisal or not. It's our job when you represent a buyer to pull a CMA. And do we need to adjust AC?
Oh, no,
Are you sure? We can crank it down more.
No, it's
Okay,
It's
okay.
me.
Okay. We need to, for the buyer, we always want to pull the solds for the neighborhood, do a cursory CMA to get an idea of, is the list price that they're asking at market value, above market value, below market value? Because when we decide to write an offer, we want to know, A, how to write the offer, but we also want to know and let the buyer know this list price is above market value already, or maybe it's below market value. It's a deal, you know? You never want to assume that the listing agent listed it at market value, because 9 times out of 10, they don't. They list it based on whatever their seller's telling them to list it at, right? They may have gone into the listing appointment saying we should list it for this, but the seller is going to pick the price ultimately, and it could be 20, 30, 40,000 over what it really is worth. So we as buyer's agents need to protect our buyers. And that doesn't mean they can't write a higher offer, but it means they need to know they're offering above what it's worth, right? That's our job to tell them that. So the first step is to assess and figure that out. Then we're going to talk about using the CMA for listing appointments. When you go on a listing appointment, some of you have heard me talk about this before. When we go on a listing appointment, we're going to go into that appointment with a range in mind of what we think it possibly would be worth. But until we get in there and see it and smell it and pay attention to all the other factors, like maybe there's a giant water tower right behind it, or a jail right behind it, or a Walmart, or, you know, maybe the house right next door is full of trash and debris because it's not in an HOA and it looks horrible and it's going to affect value. Like there's things that you don't know until you get there as to whether it's really worth what you think it's worth. So we can't determine a price until we get to the house. And so we can go into the listing appointment with a range of mind. Does that make sense? So first we're going to assess kind of how do we look at coming up with value to write an offer for a buyer, and then we'll talk about listings. And both of these are CMA tools. In the next class, I don't know when we're doing it, we'll do the full appraisal, or is that, do we have a day for appraisal?
No, I thought you were kind of using that for this.
Well, I'm sure, I just don't think we're gonna have enough time for that. We're gonna figure out appraisal at some point. But the good news is on our roster, we just hired an agent who is an appraiser. He was an appraiser in California. He's now in Texas doing appraisals. And so he's teaching a class to the whole office in October. We're trying to figure out the date right now. So we'll get that class. There's also a recorded class on appraisal on our YouTube channel. And there's some really great handouts about appraisals on the portal and on our hub. Candy Cook is an appraiser. She's a phenomenal teacher, and she teaches appraisal CMA classes all the time through the board. And so her appraisal packet is it's on our hub and maybe in our portal as well. So enough about appraisal. We're gonna talk about CMA. The difference is that we can't do the word appraisal, but we're gonna do everything we can as close to appraisal as possible.
When you go with a range, is there an amount like $50,000, 75, like what?
So you're gonna
range is
look
it?
at the comps and get an idea. We'll talk about it. So like when you know, a home, when we're looking at homes online before we've seen the home, we're gonna see homes that may be sold for $100 a foot and some that sold for $150 a foot. That helps us to find a range going in, because until we see it, we don't know whether it should really be on the 100 end or the 150 end. Does that make sense? But we'll talk about it. The thing to understand when we're looking at trying to come up with a CMA is we always need 3 comps at a minimum. We really need them in the subdivision. Sold, yes,
What's a
thank
comp?
you.
Yes, there
Thank
you
you.
go.
Comps are within, on this page, within about 10% of the subject square footage in the same subdivision and sold within the last 6 months. However, in this market, 6 months ago was a different world. We really want as close to the now as possible. So we're gonna look at the last 30 days, 60 days, 90 days, and keep going back until we get to 3. If it's a very small subdivision or a very unique situation, we may have to go outside the subdivision, but we're not going to worry about the crazy situations. We're just going to talk about typical situations for right now. Does that make sense? So we're looking at bracketing, meaning we want to look at things that are a little bit smaller than our subject and a little bit bigger than our subject. We want to look at things, if our subject has a pool or a 3rd-car garage, we want to try and find a comp that includes those things if we can. Sometimes we can't. And again, as close to the now for the sold dates as possible. Any questions on any of that? We're going to jump in here in a second, and I'm going to show you what I'm talking about. Let me see if there's anything else. Oh, we're not going to worry about that right now. Okay. So that's the
What
only
I'll say when
page.
you're getting into it too, maybe just try to go through a whole one before you guys like write down your questions. So, because I think the flow helps better if you
That's a
can
good
kind of
idea.
go
Yeah.
through everything.
Yep.
And
Yep.
do you want a whiteboard? Because I'm
Um,
gonna get one ready for you.
Yes,
That's just in case.
that's a good idea. And I'm gonna have Mike give us, hold on one second, let me text him, because I just helped him with this. He had a good one that I wanted to use, and then I just went blank on what the address is, so he's gonna text me the address. Okay. Let's see if he sees my text. The subdivision, Soresto, that doesn't sound right. So what? Oh, that's Sorrento, maybe? Oh, maybe that's it. Maybe I can find it. Yep, okay.
These get confusing, so it's nice to just go through it and then ask your questions.
Yes, so this is a home. Let me tell them I found it. Okay, so this is a home, one of our agents right now, he has a buyer who's looking at this house. So I want to know a couple things about it. First, I'm going to just glance at it. If you're representing the buyer, you've already seen it. You're trying to decide what the value is, the CMA current market value for your buyer who's about to write an offer, okay? So, but since we haven't seen it, we're gonna look at the pictures really quickly. It's very clean, very fresh, very clean, very fresh, like cute, 1-story, great. What we care about are the bullet points, which are square footage. Do you want to write this down for me on there? Sorry.
Yeah, no, that's fine.
All right, so we are 3193 square feet. It is a 5-bedroom, 4 beds are down and 1 is up. It's listed for 609 in Sorrento, and there's nothing else to note about it. So now what I'm going to do is I'm in the subdivision. I'm going to just go to the solds. And I'm gonna start with 90 days. We are 3193 square feet. I need plus or minus 10% of that. So I'm gonna deduct about 3,200 or 300, about 300 square feet below and add 300 above to see if I can get enough comps in that range. Does that make sense? So I'm gonna go 28 to 35. Everybody with me? Staying in that subdivision 90 days. I have 5 solds. So I'm gonna go quickly pop over and look at them here. And so I've got 4 of the 5 bedrooms. Mine's a 5-bedroom. I'm gonna go back. Well, I'm not. So because, here, I'll give you guys a quiz. I said I want, if I can, I want at least 1 smaller and 1 bigger. So I was about to get rid of the 4-bedroom guy because mine's a 5. But why can't I get rid of the 4-bedroom? Can somebody tell me? Because it's, I'm sure it's hard to read. He's bigger. He's the only bigger he's the only bigger comp. So I need to use him as a comp because he's bigger than me. Make sense? But because mine's a 5, 1 of 2 things happen. Either I'm calling my 5th a 5th bedroom and maybe he has it, he's just not calling it a 5th. Like maybe it's a study and they're not calling it a 5th. Or, you know, maybe they really do have possibly a 5th. Or it just happens to be a different floor plan and they didn't convert it to a bedroom. Who knows? I'll look at it. So I'm going to assess, do I really need to add a little bit more value for that 5th bedroom or not? But the square footage is there. Does that make sense? Right? Do I need to add about $5 grand for another wall to call it a bedroom, call it a closet or whatever, to add a closet? So I'm using him for a comp. And then I need smaller. So,
That one's single story, I don't know.
well, and ours is almost a single story. Ours is all beds down except 1. So ours is as good as close to a single story as you can get. Here's where I'm going, what is going on? So the first 2 comps are smaller than subject and the bigger ones, but they sold for less per square foot. And in my mind, I'm going, why? And so my first why was it market timing? Maybe those sold recently and the others didn't, but no, not really. One did. So I'm gonna go look at those real quick and figure out what's going on if I can. And this guy has a 3-car garage, cool beams, terrible photo. Like, y'all, if this is your listing, we're gonna have talks, right? Everybody with me on this? You're selling a $500,000 home with all of 6 photos and they look like crap. That's very disappointing. Okay, this guy's a builder. So the builder, Andy's a 2-story. He's got 2 beds down. I'm gonna take him out of the mix completely. So I'm gonna do year built 2020 or less. If you are in a subdivision with new builds and resells and you're looking at a resale, you definitely want to eliminate the new builds if at all possible. I say that if in this market, the builder's selling them for better than what the resales are, that's a different story. Does that make sense? But if the new builds are more expensive, then we're getting rid of them. This agent really makes me mad. Oh, it was the builder.
Yeah.
That was the build. How was that the builder? I wonder if that was like their model that they kept forever. Because how could the builder be selling a 2015?
2015, yeah, it most likely
Something
was.
makes sense. Doesn't make sense. But when I got rid of the other new builds, we're down to 3. So we've got our 3 comps. They vary drastically. Like 500 to 700 is a scary swing. This is really cute. Ooh, great door. Like this is pretty pimp compared to ours. Would you all agree? And those are real important real estate terms, right? Yeah. No, Carlin, okay. So our two higher comps are 1 stories, ours is a 2-story. Our 2-story, I would say there was a much better plan than the Orvieto. That 2-story that the builder sold for some reason really late, but the other thing about these two 1-stories is that they have 3-car garages. We only have a 2-car garage. So that's going to affect value a little bit. But this is all we have to work with. Everybody with me so far? I say that, let me just go back a little further and see what else we end up with real quick, just to see. I'm gonna go back the full 6 months. See, we're kind of like this one, a 1.5 story. It's kind of almost like us. They have better coloring. See, he's a 1.5. He's got 3 of the beds down and 1 up, just like we have 4 beds down and 1 up. He sold for $671. He went on at $639. When did he go on the market? Let's just look. Ugh. He went on April and closed in May for more money. So it was definitely a better market than we're selling now. But he's a really good kind of, he's as close to a comp, even though we've got more square footage. He's a better comp to use. So I'm going to use him on my lower end. I'm going to ignore the outlier, the $500,000 guy. Something to me there is really weird. Like the builder's selling it. It's 7 years old. Like something happened. Terrible picture. I don't know. I'm taking him out of the mix. Does everybody get why I'm doing that? Doesn't make sense. So I'm going to look at this guy. I'm definitely taking, oh, Lord Almighty. Now we have an 840 in there. What's up with that? Well, I mean, it was just a hotter market, guys. This is the clear example of it. I mean, it's cute. It's a little more custom. I can't tell. Oh, look at that. Dang. And a hub bed. So it definitely has some features that made it more popular, but it sold, what is that, 60,000 over asking. Timing on the market, guys. April.
Cash buyer.
Yeah,
I mean, in
April.
that one, I would use the list price and say, hey,
Yeah.
it should be $779, but you.
But then you're backing out all the pimp stuff too. So I'm not using him as a
Yeah.
comp. He's too much. Now we've got this 335 guy. One at 7. He has mastered down the rest up with another garage. Boy, they like their garages, which is a good thing. This guy's a little more in line with like the darker wood that we have. But again, he's got another garage that we don't. Well, let me put it to you this way. Our subject, if we remember, is on at 609. It just reduced to 609. Based on these prices, do we feel confident we can tell our buyer we're at market value, or above market value, or we're below market value? What do you? Anyone else? Amber, what would you do?
I would say that they're a little below.
I think they're a little below. I think it's a
But
good,
it's-
good deal.
They need to sell it, so.
Yep. And that's, we're saying that all over the place. Why do I say below? Yes, these sold, a lot of these sold.
I'm so sorry.
That's okay. That's okay. It's your speaker.
Thank you.
I can't see, so.
No, it's okay.
20.
I wouldn't be able to see either. I'd have to be up here. I can't even see right here. And I have LASIK. That's crazy.
Because you see that one, that's May, because you went back 180 days.
Yes.
So the most recent ones is this one, which again,
We're excluding.
outlier.
Yep.
and then this one for
The
700.
700. And then even if we looked at the least expensive, it's at 625 and we're at 609, right? So part of the reason why I'm going to go get us back that I would say why we're still on the market and haven't sold is because it doesn't have that third car garage that a lot of them seem to have.
And when was it listed? That's
90 days,
yeah.
like right when the market shifted.
and that's why.
Yep. Oh, and it's Orchard. So
Okay. well,
they probably overpaid and now are losing their
What
shirt.
was their original list?
629.
Okay.
Not terribly off, but we don't have the third car garage. And then a lot of what we just looked at had more of the whites and grays, like in the kitchen. Like this is not the in thing right now, right? So there's some, so when you have options for the white and the grays that everybody wants, this one's gonna sit. But at some point, it's gonna get to a price where it's worth it for somebody to buy it. And that's what their 629 to 609 price reduction did, is make it worth it. Now this buyer wants it, he's gonna pay cash and get it. So I would argue it's below market value. And I would say, I feel good about writing this offer. There are no other offers. He's cash and a quick close. So I advise the agent to go in. Anybody want to guess what I advised him to write an offer at?
595.
Very
Where's-
close.
Where's it at right now?
609 is the ask price, just reduced.
590.
590 is what I suggested to write it up for.
Because it is a cash offer, you said?
Cash and quick close,
Oh.
and there's no other interest.
Okay.
So, sorry, I thought I said
No,
that,
she did, but I was just
Okay.
reiterating because
because you missed it. Yeah, no.
Okay.
So yeah, cash quick close. Orchard will want this off their books. You know, they don't want to sit on it another month. The serious sellers will be motivated. Now here's the problem. A normal seller who just came down 20,000, right? They just reduced their price by 20. And we go in and offer 20,000 below that. That can be a little insulting and upsetting. And so my advice to the agent is to say, hey, we know you guys just did a price reduction. If this was a normal seller, this is Orchard, so I don't really care. But you don't want to upset a normal seller because you don't want them to not respond to your offer, right? So you would say, hey, listing agent, look, I'm going to send you an offer. We're cash quick close. We really love this house. But I understand if my offer isn't going to work for you. We've got a couple others that we're going to make offers on if it doesn't. But so I don't want you to get hung up on our number. Like if it doesn't work for you, it's okay. And the approach is like very nonchalant, you know, it'll work or it won't. We don't want to offend you, because then they'll be like, oh crap, they're going to walk if we don't make this work.
Yeah.
Right. I'm presenting like, hey, we're not here to negotiate. Like they are willing to negotiate, but we don't want to show that hand. Does that make sense?
Yeah.
And so you're taking the approach of, hey, we've got others to choose from. If this doesn't work, no problem. You know, please don't let this insult your seller. We understand you just did a price reduction. I get it. For us, it's a numbers game. It either works or doesn't. And so that's how he's going to approach it. And with Orchard, they'll probably take it because they want it off their books. And another seller, it'll depend on how motivated, how desperately do they need it. If it's sitting there vacant, it's costing them money every month, right? And if it can be off their books in 2 weeks, it's very appealing. They may go for it. But doing a 20 grand offer below what they just reduced to can sometimes sting a little for sellers. So you just got to be careful on how you present that. Does that make sense?
Yeah.
Does that help everybody?
also
Okay.
this is a cash offer, so why are you doing a CMA?
Thank you, Amber. Because this listing agent, this could have started at $799, right? And then you're offering 100,000 more than it is worth, or 200,000 more. You know, like you never want to trust what the listing agent's price is for market value. You never want to think that. One of the worst situations we ever got into as a brokerage, and I cry about it every time I think about it. One of our agents, bless her heart, newer, wrote an offer off market. The home never went on the market. The seller said, this is the price, this is what you need to pay to buy it. And the buyers were so excited to find this home off market. And this was before the crazy, this was years ago. They just like, they had to have this neighborhood. They found the home, great. So the agent wrote the offer, went under contract, VA had to appraise, no money to give. Spent money on inspection, option, appraisal, all of that. And we were clearly like 70,000 off when we went to pull comps. So it didn't appraise. And she called me crying, like, what am I going to do? The seller doesn't want to give anything. They didn't even go on the market. And I said, well, did you pull the comps and look to see if her price was even in the ballpark? And she had it. she just assumed the agent was right, it was giving her a market value price, and I was like, oh my God, no. Like, we were so off the mark. And so you never, like, a VA buyer, unless you know that seller's willing to come down, you know, you don't stand a chance. So it was a brutal lesson to pay, to learn.
Take them out to see the house and they like that house and they want to submit an offer.
The first thing you do is go pull the comps and say, hey, based on these sold, so what I would send to this buyer is, of course, we've added stuff, but the 3 that we were talking about, like, and honestly, what I would probably do is send all these comps. Well, no. Did we go back? Oh, I went back. Yeah. I mean, I could send them all of these and say, these are the comps similar to yours for the last 6 months. Based on what I just reviewed of these, I am confident we're getting this below market value.
Can you show the quick CMA? Is that how you
Yeah,
would
so
do
if
it?
I select all of these, or ideally you select the 3, right? But I can't remember the 3. So let's just say I picked the 3. I could do a quick CMA, and it's gonna spit out all of their terms. It's then gonna do an average and median for all of them. And so it'll tell you that the average sold price between them, that I can't read at all on this, is 685, and we're getting it for 609, right? And at almost 3,100 square feet is the average, and we're at 3,200 square feet. So, you know, sending them this would give them good confidence. Now, this is skewing that because that $840,000 guy's in there, and he's not really a good one either, right? We got a high and a low in there. We need to get out of there.
Is the total price more important or price per square foot? Like, which one do you look at
That's a good
more, since
question.
they're not the exact same square footage of it?
So you would want to do the price per square foot if we were close, right? But our value is so much lower and we're bigger than most of these that I know I don't have to do the math, but normally you would do the math.
So normally the price per square foot would be more important or.
So
important than
what you would
figure.
do is look at basically the average price per square foot, or find the one comp. Like if we looked at that one comp that I really like, that I feel like is very comparable to us. As long as his price is in line with everybody else, I would look at his sold price per square foot, which is 233. And then I'd go, okay, we're on at 3193. That puts us at 743. Now, again, he sold probably when the market was a little higher. So wouldn't want to pay that, but we're so below that, I'm not worried about it. Does that make sense?
So it's 3 plus your subject, or is it your subject plus the 2 to make it 3?
No, 3. 3 solds.
Okay.
So you need 3 solds, your subject's not in the mix at all. Yep. Let's go do another one, okay? Is there any house that anybody has a buyer looking at that we want to practice
That's
on?
good for below. We need to find one that's above.
I was just gonna do one on mine. An updated one.
Yeah, let's do it. Let me go up. So one thing I will let you guys know, well, no, we'll do it. We've got time. Okay, let's do it. What's the address?
1263 Old Lockhart Highway, or I'm sorry, Old Lockhart Road.
Entrance. All right. Okay, so we are in Lockhart for 395. We're a manufactured home, right?
Correct.
And we're on acreage. Okay. So hers is a little different. She gave me a goodie. We're going to close the last 90 days. The minute you're on acreage, there normally isn't a subdivision. Yours is not, right? Yeah. So when there's not a subdivision, we're going to do within mileage, 12, what is it? The address?
1263
63, okay.
Old Lockhart Road.
You got to type slow and let it keep. There we go. So I know we're not going to get, before I start spreading out the mileage, I'm going to do the acreage. So when we're on an acre, I'm going to do plus or minus like 3/4 to 2 acres and see what I get. I'm also gonna make sure we're only looking at manufactured homes. And right now we're within a quarter, which obviously isn't gonna happen. So I'm gonna go to 5 miles and just see. We have 6. Okay, let me go look at those real quick.
Could you not consider modulars?
There probably aren't any, but you
Yeah, it's-
could.
Probably gonna knock it down.
There's
Oh.
one more. Modulars are pretty rare and most agents categorize them wrong, but I mean, it's in there. It's okay. Okay, so now what was our subject square footage?
1891.
Thank you.
That's what I saw.
So I'm gonna do 17 to 21. I'm doing plus or minus about 200 square feet each side and I'm gonna see how many I get. I've got 3. Year builds are all over the place because of what we're looking at. So manufactured homes on acreage out there, you know, you're gonna see everything under the sun. This range is enormous, 180 to 340. And the crazy thing is, the 180 is the newer home. That's weird, but he's farther out of it. Let's go look at
The
the
180 newer?
The 180 was built in 2016 and the 340 guy was built in 2004.
The one we have is a 2021.
Yes, yeah, I know. We're not gonna get any new. But we're gonna go look at them and just see. Oh, so this guy's not, yeah, I remember looking at this when we looked. He's not even done, like he's newer, but doesn't have flooring. He had to have sold for cash, and he did, poor condition, yep, all right. Then we've got this one. Cute and clean. With a pool, above ground and a deck. Cute land, like you want to always look at land when you're on acreage. Does it have trees or a view? If there's no trees, that makes it worth less. There's some great advertising there. To me, this sold just for the land. Yeah, the interior, the house is a tear down. This was the land. So this helps give you an idea of the land alone. For an acre sold for 200,000. That, the reason it sold a little high for the acreage is because the utilities are all there. So it makes it much easier for buyers who want to put another manufactured home on to come in and connect and saves them a lot of money. So keep that in mind.
Okay, you can try another one.
No, it's okay. No, I like a good challenge. Damn it. No. I'm gonna get rid of my square footage and see what we do on values here. So we've got a 389, 1,400 square feet. Let's just go look for fun. Very cute. So this interior is much similar to yours. The land's not that exciting, but he also sold $2 grand in repairs, sold in July, so it was better market.
275.
Yeah. He's smaller. Yeah, no concessions, but there's 2 pairs of repairs. What's that?
Where does it show you if there's?
So
concessions?
BCCST or buyer's closing costs, those would be the concessions.
Oh, I see.
So you want to back that out of the sales price
Okay.
in your calculations. To me, this was at market. This sold for this price because of the market. Now it's a comp you need to help you for sure. You know, we're considerably larger, but we don't have any other comps to support your price. This guy though is smaller. He'll help.
Is there anything else pending or under contract?
Oh, he's got that shop. Ooh, another thing.
We found
What
one
type of loan are you getting?
FHA. There was one in Legend Oaks subdivision that we comped for it. in Highview Ranch.
So if I didn't know what I know about her offer, I wouldn't be hunting. I'm hunting.
And why are you hunting? Because of the
Because we're
price?
not anywhere near her
Yeah.
price is my concern. And I'm legitimately worried you may not appraise, but,
That's what I'm now worried about.
okay. Do you remember the address of the comp you found?
Yes, 263 NE Oak.
Got
Arbor.
it, got it, right there, 380. Okay, so he's a brand new guy on an acre, bigger. So he's, 300 square feet bigger, 200 square feet bigger than yours. So that's gonna adjust it some. He's a little,
He's a little bit bigger on acres, but they're not gonna make it.
no, that won't adjust.
And then the others.
You don't have the comps for the, where are you at, 385 price, 395?
395 is seller concession. That's what I'm looking at now.
You're not.
Okay.
You gotta have 3.
Yeah.
Like, the thing to keep in mind is what an appraiser is gonna do is take the 3 comps,
Mhm.
ultimately make adjustments to them to get to the right square footage, like the subject, and then he averages the 3 to come up with a price per square foot, multiplies that by your subject square footage, and that gets you your price. So all 3 need to adjust to get at or above your sales price,
Mhm.
or you're screwed. So if our starting price isn't even near the sales price,
So the one you just looked at closed at 380 and it's bigger.
bigger, yeah.
So-
Is this a listing? For
A buyer.
And that's the
Buyer.
highest sold
Yeah.
there is in a 10-mile radius.
Can you pull up 115 Green Mountain Drive, which is another comparison that was used?
Yeah, he's not within 10 miles of our subject. He will not be used as a comp.
Okay.
They won't even want to go 10 miles. He will
Mhm.
only want to go 5 at the most. That's 3. I say at the most, right? Sometimes they can't help it. They just, the problem becomes every oddity an appraiser has to do, go further out, look at a different subdivision, whatever it is. He has to justify to the lender why he had to do that, because the lender hates that stuff. And so they try never to do that. They would rather go back further in time in sales in the area than go further away.
So Connie, I mean, there's big ranges here. We got,
We have huge ranges.
yeah.
So we
your
would-
Builds are just all over the place. I mean, how do they determine that?
So what would happen, what the appraiser would do is go through this list. This is our 5-mile list. We would go through this list. We need one bigger, one smaller, one newer, one older. And then he'd make adjustments to make it like our subject. So he'd adjust for square footage, adjust for year built, and get rid of the pool, get rid of the garages or anything else that doesn't match ours. And then you'd end up with a price. But because all of these are below our asking price, I know for a fact, there's no way we're appraising. Does that make sense?
Right.
So he'll go through these pictures. These 7 is what he has to work with ultimately.
You went back 90 days?
Yeah, we could go back
However, are
180,
we
but
able to, we're only, when we pull comps on a manufactured home or mobile home,
Mhm.
we can only pull comps on other mobile homes, not like a brick house.
Correct.
It has to be-
1,000%.
Okay.
Yeah, and keep in mind, manufactured homes and mobile homes are 2 different things. So be careful using that language interchangeably. So a mobile home truly is mobile. It has wheels, a hitch, it's a single wide, it can move.
Oh, it's still
Whether-
sitting on it?
Well, so let me finish.
Okay.
A single wide is a trailer that is personal property. So it's not even real property that we can sell. Like it can happen to come with the land we're selling, but a trailer is like a boat or a car, truck trailer, like it's personal property. So there's land where you can buy a mobile home on it, but that is a single wide. It may be permanently on the ground, but it's not considered. It can get converted to real property, but it's a totally different product. A manufactured home is a double wide at least, and it must be permanently fixed to the ground to convey with a loan. So a conventional lender or an FHA lender will only buy if it's permanently fixed and there's all these rules it has to meet. It's the whole thing. FHA is the hardest. Who's your lender on it?
Austin Mortgage. and
Okay. And they know it's a manufactured home and all that? Okay,
Reagan, Lakeland.
okay, good.
So lenders won't mess with single wide.
So no, it's like a boat loan, totally different. And so if you do a search in here for mobile, you're getting a totally different product than manufactured home. Does that make sense?
Oh, okay. that
So
makes
that's why you
sense.
don't want to use those words interchangeably.
Okay.
Okay.
So here, what I'm gonna do as an example, I'm gonna pull the three. So if I use the three best comps I can,
In price.
yeah,
Okay.
we're still at 355.
Mhm. Let's chat after.
Okay. Yeah. All right. We got a few more minutes. Okay. Let's talk about listings real quick. Okay. Who wants to give me an address that we can use? That's in a normal subdivision for time. We don't want to get,
801 Ladder Ridge, Latterie.
is it all one word?
Yes.
Okay. So the minute you guys are through this program and done with mentors, if you have a listing appointment and you want to pick my brain on value, you will email me the address. You'll email me anything you know about the home before you're going on the listing appointment, like they added a pool, there's a detached workshop, anything funky that I'm not gonna see from tax records that you're gonna tell me in the email, but do not give me your price. I will go pull it and then give you what I think, okay? I'm happy to do that. I do it all the time. So the first thing I always do is go to the tax record. So what I did in MLS back here, I went to tax realist. That popped up and I searched, it's a 3-bed, 2-bath, 1,436 square feet, built in 95. And we are in Parkwood. And we're just gonna go jump into Parkwood real quick and see what's going
Sorry,
on.
what was it, 1490?
1435,
1436, you said?
hold on. 1436 in Parkwood. I'm guessing it's probably a 1-story. It's on the tax record, but, oh, is it really?
Oh,
Oh, Lord.
interesting. But primary downstairs.
Okay, that's good. Let's just go see what's going on in Parkwood. Okay. So 8 actives, 2 pendings, 1, 2, 3, 4, 5 solds in the last 90 days. So now I'm going to narrow down my subject square footage because that's too many, but we're going to see how we do. We're going to go 1,200 to 1,700. I only have 2 solds. I'm going to do 1,800 because we're not going to find anything smaller. And I got 10. Wow. All right, let's just look. Oh, I got 3 solds. Okay, and a bunch of actives. So this is a good example of paying attention to what's going on in the active world. Because you got a 1,500 square foot for $499 there. Okay, so this range is a good range. We're
The 699 was completely updated
okay.
and the rest are all.
And he's sitting there, like he's sitting. Yeah, well, you can tell why he's sitting, right? He's 200,000 more than, good Lord. But our range of solds, so the 485 to 565 is a range, but it really isn't a range because our subject isn't those square footages, right? So here we're going to look at kind of the price per square foot. The low end is 327, the high end is 365. But what I worry about is the market shift, right? I still worry that these guys probably,
The one was September, so it was a little bit.
okay, 1436, so 469 to 524. 469-ish to 524-ish. Okay, so then the other thing though is I want to know how many of these are 2 stories. I got two stories, both sold at 565. That's interesting. So I'm gonna go look. I mean, it's clean. So funny to me that the builder built a floor plan like that.
It was 1995.
I know. That was just the thing to do, apparently.
And you can tell.
Yeah.
And the
Interesting.
subject is on a green belt. Does that make a difference?
It will help it to sell. It's not gonna add value. Okay, so I gotta take out my 2-story because I don't have enough. I don't have 3 comps. But so for me on a listing appointment, I'm gonna go in with that like 460 to 520 range in mind. I don't like necessarily going over the 520 because they're sitting. I mean, you know, the 525 guys at 90 days. Let's go look at them real quick.
I was gonna say, I told her upper 4.
Okay.
Mid to upper 4s.
And I think that's a good, yep, yep. And he's cute. This guy's sitting and he's cute, you know, like his kitchen's updated. No funky good deck, you know, he's sitting. So yeah, so you need to be, and that's the risk of this market. Like in another 90 days, we'll have a good 90 days of this market selling values, right? But we're not there yet. We've got stuff sitting on the market that's still too high. There's the sellers are too stubborn. And then the sold prices can be from when they went under contract while the market was still hot. So that floor plan is clearly okay in that neighborhood. But if that was the house in another neighborhood where they weren't all like that, it could be like the kiss of death, right? 1,400 square feet is tight, and then you make it a 2-story and it's really tight, right? So same thing to keep in mind when the master's up. If it's common for the neighborhood that a lot of the 2 stories are masters up, then it probably won't hurt it. But if it's really unique and it's the only master up, it could be the kiss of death. So that's something to keep in mind. Buyers, your biggest buyer pool is with a master. Your biggest buyer pool are 1-stories because the elderly love 1-stories, brand new baby families love 1-stories, single people love 1-story, right? Everybody loves a 1-story. The minute it's a 2-story, if the master's down, then like parents with teenagers love that. And older people can do it still, right? Separate family upstairs or whatever. But the minute that master goes up, a lot of those people don't want those homes anymore, right? And so when your buyer pool narrows, your pricing is going to go down and it's going to take longer for it to sell. So it's something to keep in mind for a listing appointment. Like when you're looking at comps, you really want to try and look at comps like that floor plan if you can. And then if your buyer's going to buy that floor plan because it looks like such a good deal compared to the rest of the neighborhood, you say, well, this is why. This is a very unique floor plan that most buyers don't like. That's why it's sitting here on the market. That's why they've had to reduce it. Now you like it. But when you go to sell it, you're going to be yelling at me because it's going to take us a while to sell it. Like, you got to keep that in mind. Or you're going to hope the market does what it just did and sell it.
So another thing, strategy wise too, if you were listing this week and you see those actives, what else
So
would you use?
So the first question, and I don't know why MLS Area 3, he doesn't belong in that. But it's bugging me, but that's okay. So, you know, I would study. So he came down. I was gonna say he's a good price, but he just came down. You know, I would study these actives, my competition. And if we're going on the market, like right now, I would want to be under that 499 guy if I can. He's a little bigger. And I'm a 2-story and he's a 1-story, right? Oh no, he's a 2-story. Well, that picture's a little deceiving. He's cute. Interesting. Cool. He's cool. So I want to look at who I'm directly competing with and try to be either more appealing for the price or a little bit better on price if I can. So normally what I do is I'll go on a listing appointment like this and I'll say, you know, mid to upper 4s. I think she's right in line. But then I say, you're going to do my staging, get it ready. And so when we go on the market in 3 more weeks, right before we go on the market, I'm going to reanalyze what's going on with the actives and the pendings and solds. And we're going to finalize a price based on the conditions at that time. Does that make sense? And you really want to do that, like pay attention to what's happening. Because Because if things are still sitting and now we're going into the holidays and we really need it sold, that's a different story.
So you wait 3 weeks to go live? Or-
No, I said that as the example,
Okay.
like that's kind of the average. Normally an agent's gonna go on a listing appointment and they're not gonna be staged and ready for photos when you do that. You're gonna go on the appointment. It's gonna need staging. By staging, I mean, I believe in paying my stager $150 to do a consultation with that seller. As soon as I'm done with that listing appointment, I say, Mr. and Mrs. Seller, I'd love to get my stager out here this week. They're gonna go through your home, make a list of everything they suggest you do to help get it ready to go on the market. You do not have to do everything they tell you to do. It's just suggestions, but the more you do of that list, the quicker it's gonna sell and the more money we're gonna be able to get. And then I let my stager go be the bad guy. I let her go say, take down little Tommy's pictures and get all of the crap off the fridge and, get the deer head off the wall or, I don't want to be the person offending them. I let my stager go do it. And then I call my stager and I go, hey, you're going to see this house. I need you out here this week. It's real. They got to get that deer head down. The husband's going to want it. You have a tough battle. And I make sure she knows what I want to have happen. And then I let her go be the bad guy. And she usually will know what I want to have happen, but I still will stress like, hey, they really love that blue wall. I need the blue wall painted, whatever it is. And then she goes and be the bad guy. And then they usually will listen to a lot of what she says, but it will take them a couple weeks to do that work. And then we go on the market.
Do the stages usually supply stuff like?
No, so this staging is just a consultation. My stager that I use, her name's Stephanie Parker. She will try to use stuff they already have. Sometimes she'll say, go buy a cheap bedspread from Marshall's or something. Like she very rarely suggests going to buy stuff if she can avoid it at all times. What she really mainly does is make them pack stuff up, depersonalize, declutter, make the rooms look bigger, put stuff in the garage. Like, I don't care if we fill up the garage, the house has to look good. And in this market, as the market has shifted, it is really important we're doing all of that. So the $150 you're going to spend up front will get you more money on commissions because it's going to sell for more money and it's going to sell quicker and it's going to be less of a headache for you. So every listing I did, unless they were fabulous decorators, I had a stager every single time. The only time I need furniture staging is if it's a vacant floor plan that's higher end, that is a difficult floor plan to envision where things will go, then I would bring furniture and do all that. But otherwise, even vacant smaller homes, you can do box brownie, which is virtual staging. We get a discount through corporate with that. You send them the vacant pictures and tell them what kind of furniture to put in it. And then they do the furniture and it looks amazing. Like I can show you some examples in our next class. But yeah,
Will a stager talk about outside stuff too?
everything from the front yard through the backyard. Yep, every little piece. So on my listing appointments, I was like, I use professional photography. I use a stager. In this market, we're going to start talking about pre-inspecting, but we're not going to worry about that right now. So I would say, hey, I want to get my stager out here as soon as possible, but I can't call her to get her out here until you sign that listing agreement. So I make them sign the agreement at the appointment. Then I call my stager, I get her out there as soon as possible. And then I call them right after the staging consult and I say, how long do you think you need to do the work? And I also get them off the cliff because they're kind of stressed after talking to her. And I'm like, look, you don't have to do it all. Do what you can. Let's just do what you can. But I make them set a date. When can I schedule the photographer? Oh, we need 2 weekends. Great. I'm gonna schedule the photographer for the Monday after the second weekend. And then that way that gives them a deadline to work towards. Because if you just let them keep working and you check in, it's never going to get done. But you say, I'm scheduling the photographer. Now you can always move the photographer if you needed to. You'll check in with them again the weekend before. Do I need to move the photographer? But don't tell them you can move the photographer until like they've been working on it for a week or two. Let them work towards that date. Does that make sense? And we'll talk about it all in listings. But I need to let you all go because I have to be in Buda by 1 for the Buda Halloween planning. And thank you guys online. And we'll do more CMA and appraisal stuff. We'll squeeze it in again. So okay. Awesome.
I know you said you were gonna talk about pre-listing thing later, but can you like for 2 seconds say what your thought on that is? Because I'm not sure if only one thing